The rupee gained 39 paise this morning, and by lunchtime a chunk of it had simply evaporated. Here's what happened on Wednesday, the 5th of August 2026. The rupee opened at 94.90 against the US dollar and firmed to 94.89, its strongest showing in days, as traders positioned themselves ahead of the Reserve Bank of India's policy verdict. Then the verdict landed. The RBI held its repo rate, the rate at which it lends to commercial banks, unchanged at 5.25% and kept its stance neutral. And rather than celebrating, the currency quietly handed back part of its gain. That reversal tells you far more about India's position right now than the headline number does. This is now the fourth consecutive meeting where the RBI has sat on its hands, and every single policy meeting this year has ended in a hold. The last actual move was a 25 basis point cut, and since then the Monetary Policy Committee has chosen patience over action. Why? Because it is caught between two forces. Domestic growth is steady enough that emergency support is not needed, but inflation risks are creeping back, driven partly by energy costs. Cutting rates now would weaken the rupee further by narrowing the gap between Indian and American yields. Holding buys time. Crucially, the RBI did not stay idle behind the scenes, injecting roughly 6,956 crore rupees into the banking system to keep short-term funding comfortable. So what does a hold actually change for ordinary people? For anyone with a floating rate home loan, your monthly payment stays exactly where it is, no relief, but no fresh pain either. Savers keep decent fixed deposit returns for a little longer. Importers, though, are feeling it. A rupee near 95 to the dollar makes crude oil, electronics, and foreign education meaningfully more expensive. Equity markets have been jittery too. On Tuesday, the Sensex fell 533 points, roughly 0.63%, to 84,679, while the Nifty shed 167 points to close near 25,860. Today the mood steadied, with the Sensex clawing back over 150 points once the certainty of a hold removed the guesswork. In the near term, the direction of the rupee is likely to be decided by oil, not by Mumbai. Every dollar added to crude widens India's import bill and pressures the currency, which is precisely why this morning's rally faded as oil firmed. Expect the RBI to keep defending the rupee through targeted dollar sales rather than through interest rates, because a rate rise would hurt growth and a rate cut would hurt the currency. With the stance held at neutral, the central bank has deliberately kept both doors open. Watch the next inflation print and global energy prices closely, as those two numbers, more than any speech, will determine whether the next move is finally a cut. Here is the takeaway. A steady policy rate is not the same as a steady currency. The RBI has frozen rates at 5.25% for the fourth time running, yet the rupee still could not hold 94.89 for a single session, because India's currency is ultimately hostage to the price of imported energy and to global risk appetite. If you are investing, budgeting for foreign travel, or paying an international tuition bill, plan around a rupee that stays under pressure rather than one that rebounds sharply. Stability from the central bank is real, but it is stability of policy, not of price. Understand that difference, and today's market makes complete sense.